So the Federal Open Market Committee, aka the Fed, cut their target rate this week by 50 basis points. First rate cut in a number of years. Is this good or bad for stocks? Well, the answer is yes and yes, but it depends on your time frame. We're going to look at a chart of the S&P 500, what tends to happen after that first rate cut. Before we do so, I did want to let you know Seeking Alpha is actually raising their prices at the beginning of October. I would say it's still way underpriced relative to the value that you probably get out of the platform. But I did want to let you know it's a really good time to go to Seeking Alpha and check it out. If you go to marketmisbehavior.com/Seeking Alpha, you can get access to this fantastic website. 3 things I'll tell you about that I use often. Number 1, what they call the market data section. And I love the fact that they just lay out key ETFs for pretty much everything, where they're looking for dividend payers, for emerging markets, for growth or value or style or market cap size, all of those different things. There's an ETF that probably tracks that space, and they've done a great job of sort of curating the key ETFs you probably want to analyze as an individual investor. Second thing would be what they call comparisons. They do a great job of sort of looking at things like 5G plays, airlines, AI stocks. And when you click on one of those categories, they give you example stocks that are in that group, sort of that peer group, and they help you understand the relationships and the performance within that space. Now, this is more how institutional investors think of the equity universe, and it's giving you those tools as an individual investor. Finally, I would go to Stock Screener, and this is a part of the platform that I love quite a bit, because you use their quant score. Now, any institutional investor knows you need to have a quant model. This is what we call an alpha model, a way of analyzing the characteristics of successful companies in previous cycles and looking for stocks demonstrating those characteristics today. They have a robust quantitative model using best practices, looking at price momentum, earnings quality, and a lot of other things. If you dig into that Stock Screener, you can leverage an institutional quality alpha model as an individual investor. Go to marketmisbehavior.com/Seeking Alpha. It'll give you a little better deal and allow you to get in a lower rate before the prices go up at the end of September. So make sure you check it out today. Let's get to the charts. This is a question I've gotten quite a bit here recently, and certainly in previous rate cut cycles, right? Rates have been going higher. They've been remaining elevated for quite some time. And then this week, we got that first of what will most likely be a number of rate cuts going into the beginning of 2025. So million dollar question, is that good or bad for stocks? And the answer is, it tends to be good in the long run. It tends to often create some pain in the short run, and I'll show you what I mean. Here we're looking at the S&P 500 on a log scale in the top panel. I've highlighted in a blue vertical line when that first rate cut has happened. And then in the bottom, just so we're clear, this is the Fed, basically the implied Fed funds target rate. So this is showing you when a rate rising period or rising rates period, when rates remain elevated, and then when there's that first initial cut, and you can see that rate cut cycles tend to happen for quite some time. So a couple observations just right off the bat. Number 1, this doesn't happen that often, right? So when you ask about what happens when the Fed cuts rates, going back for the last 25 years, this is only the 4th time that we've had a rate cut cycle. So it just doesn't happen very often because it's all based on the economic cycle. And the economic cycle takes years and years for the economy to grow, for the economy to shrink and go through that sort of normal cyclical pattern. These are more secular moves, not cyclical or tactical moves. So if you're more of a swing trader, this is a way longer term perspective than you're probably comfortable with. But I think it's important to understand it because this is where a lot of big money, where big institutions are operating on this sort of time frame. So understanding their motivation, understanding what their expectations are can help you be better equipped to understand the short-term dynamics, which a lot of times are driven by those big assets floating around. So the last time that this happened, it was actually in 2019. It was in July of 2019, this first of a couple rate cuts that were happening sort of in late 2019. Now, you did get some emergency rate cuts during the COVID era. So I would say it's probably hard to draw too many conclusions from this one, when you're looking at like 6 to 12 month returns after that first rate cut, because we had the COVID pandemic, or at least the beginning of the pandemic that happened during that period. I think that threw a lot of normal cyclical activity out the window. This is very much a one-off, sort of unusual event that I think will probably skew averages in a lot of ways. And certainly the charts were pretty disrupted very, very quickly. But, worth noting, in like the 6 months after that first rate cut, going into February of 2020, the markets actually looked pretty good, right? And the market was continuing to push higher, even though rates were starting to go down. Go back to the previous two observations, you can find a very different story, and in a lot of ways what had become a very consistent pattern of that first rate cut really being the beginning of a series of rate cuts, and usually meaning quite a bit of deterioration in stock prices. If you look here, this was the great financial crisis, so you had it in I think it was September of 2007 when you had that first rate cut. That was just obviously before things really started to be challenging in 2008, leading into a March 2009 low. So the market was actually relatively weak for the next, call it 18 months. Before that, it was in January of 2001 when we had the first rate cut after the tech bubble burst. A lot of people think the tech bubble was like this moment and then the market just kind of went down. It really was not. The market had rotated lower. 2000, which ended up being the peak, was not horrible. The market overall was down a bit going into the new year in 2001, but it was actually holding up quite well relative to looking back how precarious things were because they had grown so aggressively in the late 90s. You had the January was the first rate cut. Obviously 9/11 happened about 6 months later, a little more than that. And that ended up leading into an October 2002 low, a secondary low in March of 2003 before the recovery phase. So if you're looking back on, is it great news that the Fed finally cut rates? It's super unclear. And I would argue that if you have anyone that tells you, here's what usually happens after that first Fed rate cut, it really is, these are very unusual events, or very uncommon, very infrequent events. 1995, 2001, 2007, 2019, those are the last four rate cuts. So it just doesn't happen that often. We're averaging about one every 10 years. And the reality is, if you're comparing right now to 1995, that was, 30 years ago. The market structure is very different. Everything's different at this point. The whole world is different in so many ways. So, trying to draw relationships over that sort of frequency of time, I think is very, very difficult. Now, another sort of, extension of this, if you're thinking about what the market tends to do after the first Fed rate cut, I think you also want to think about the shape of the yield curve, because they're all very closely related, of course, right? As the Fed is lowering their target rate, that is at the very shortest end. It's basically an overnight rate. And then from there, a lot of other rates are sort of projected beyond that, or sort of derived from that Fed rate. That's why we focus so much on that. The top half of this panel, I should note, by the way, this is a chart we shared for our Friday episode of Chart This with Dave Keller. So make sure you tune into our live stream every market trading day after the close, right at 1 p.m. Pacific, 4 p.m. Eastern. And we'll be back live recapping the markets on Monday. But this is a chart that we shared in our mailbag episode because I was asked about the yield curve, and because it's now more normalized, right? 2-year yields finally back below 10-year yields. This top chart is showing you the spread between the 10-year yield minus the 2-year yield. So if it's a normal shaped yield curve, the 10-year minus the 2-year should be a positive number. If we get an inverted yield curve, that means the 2-year point is above the 10-year point, will go below zero. And that's what's happened, again, only 1, 2, 3, 4 times in the last 40 years, right? So again, these are things that don't happen super frequently. And I always remind you that, the further left you go on like a weekly or quarterly chart, or monthly chart, you're getting into a very different world, right? The market was just very different in 1990 than it is in 2024. So let's just remember, keep that historical perspective, proper perspective on how different some of these environments were. However, look at the remarkably consistent pattern, despite the differences in these market regimes, how consistently that this tends to play out. Here's the normal course of events when you have a yield curve that has been inverted. The inverted yield curve implies skepticism about future economic growth. That is basically bond investors, pricing in a shrinking economy or less growth than they're used to. Finally, you have the yield curve coming out of that inverted structure, and I've put a red vertical line to identify that where it comes back to a normal shape. You then have the yield curve more normalized, where the long end is higher than the short end. These shaded areas are a recession, but look what happens between often when you have that yield curve becoming more normalized and the recessionary period. Stocks tend to sell off. This bottom panel shows you the S&P 500. So the pattern is the yield curve is inverted. It comes out of that inversion. Stocks sell off. Recession occurs. In 2001, end of 2000, we had the yield curve back to normal. You had stocks selling off. We had a recession. In 2007, we had the yield curve more normalized. We had stocks sell off. We had a recessionary period. Even in 2019 to 2020, again, COVID created sort of an unusual dynamic, but all of those things played out as well, right? We had an inverted yield curve briefly in the third quarter of 2019. Stocks sold off eventually in early 2020 around the COVID experience, and we did have a brief recession, the COVID recession, as it were. So what's concerning right now is you have the yield curve once again getting normalized. And while that seems like, shouldn't this be bullish, that the yield curve is now more normal and no longer inverted? The fact that the Fed is now cutting rates. The reality is, over the long term, right, if you look at what happens after these recessionary periods, the market recovered in the 1990s. The market recovered in the mid-2000s. The market recovered in 2010 and 11. The market recovered in 2021, right? So after this, right, if your runway is long enough, these are all great things for long-term portfolio performance. But in the short term, it has often been a challenging, if not rocky, uncertain period for risk assets like equities. What do you think about this brief analysis about Fed rate cuts, the yield curve, and performance for stocks? Don't forget to drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.